All right, so we're jumping straight into rocket companies today. You've probably seen the stock chart. I mean, the year-to-date return has been massive, something like over 80%. But the true market signal here isn't just that recent rally. It's the fact that this company is already seeing a significant acceleration in loan volume and operational profit. And this is all happening before the Federal Reserve has even officially committed to a rate cutting cycle. So we really need to look closely at what this, unexpected momentum means for the stock's real earnings power.
That's the critical thing we're exploring. The stock is running on anticipation, for sure. But the underlying numbers suggest the turn is already happening, which is a really powerful combination. You're tuned into the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us today to understand what Rocket Company is building right now.
And if you are finding value in this analysis, getting these fast shortcuts to being well-informed, make sure to subscribe. Hit that like button. It really does help the channel. And definitely let us know in the comments which stock you want us to simplify next.
All right, let's look at the bull and bear case for rocket companies right now. Let's start with why this momentum is building, maybe even ahead of schedule. The first thing that really jumps out is the sheer financial strength they showed in the third quarter of 2025.
Yeah, that's where the story starts to get really compelling. Their total adjusted revenue came in at what, $1.78 billion. And what really stood out to me is that this number actually beat the high end of their own guidance. When management is conservative like that and then delivers a big beat, it kind of suggests they're setting the stage for more positive surprises down the line.
Exactly. And this outperformance wasn't fueled by, some kind of financial engineering.
Yeah.
It was driven by actual volume recovering. Closed mortgage origination volume was up 14% year over year to $32.4 billion. But here's the forward-looking part that's even more telling. Mortgage rate lock volume. That was up 20%.
Okay, so that's the leading indicator, the lock volume, which confirms that demand both for purchases and for refinancing is really starting to accelerate off those cyclical lows.
Absolutely. And volume recovery alone isn't enough, right? Your margins have to hold up. And this is where their focus on efficiency really comes into play. Management executed a pretty significant operational restructuring. It's expected to deliver about $80 million in annualized cost savings. They're not just waiting for the market to save them.
That proactive part is key because it gives them a structural tailwind no matter how fast rates drop. But on top of that, they're also targeting revenue synergies from their recent deals, specifically integrating Redfin's mortgage operations and acquiring assets from Mr. Cooper. They're looking for an additional $60 million in revenue synergies from those. So you combine $80 million in cost cuts and $60 million in revenue lifted. That's a huge boost to operating leverage once volume picks up.
And then if we look at the balance sheet, it provides us a crucial layer of safety and flexibility. They are sitting on a massive $13.6 billion in total balance sheet value.
That's a huge number. But how is that broken down? I mean, what does it tell us about how prepared they are for the rate cycle? Because holding $13.6 billion is great, but why not deploy it more aggressively if they're so confident?
Well, I think it's just smart capital allocation for right now. That value is made up of $6 billion in available cash, which is just immense dry powder for them. And then, crucially, the other $7.6 billion is in high-value mortgage servicing rights, or MSRs.
Okay, we need to pause on MSRs for a second. That can sound like jargon. You called them countercyclical. What does that actually mean in simple terms?
Think of it like a natural hedge that's built right into their business model. So when interest rates are high, like they have been, very few people refinance. That hurts their origination revenue. But those servicing rights, the right to collect payments on a loan, they actually become more valuable because the underlying mortgages are locked in at lower rates, so people are much less likely to pay them off early.
So the MSR value goes up when the origination business goes down, which helps stabilize everything.
Exactly. And then when rates finally drop, the MSRs let them aggressively target those same borrowers for a refinance. It's a process they call recapture. Rocket's huge portfolio is basically preloaded with customers just waiting for the Fed to give the signal.
Which brings us to what is, I think, the most interesting part of the whole bull case, the competitive moat. It feels like Rocket is positioning itself not just as a lender, but as this vertically integrated homeownership operating system.
That's the strategic shift, yeah.
Yeah.
They're building a platform that spans Rocket Mortgage, Rocket Homes, Rocket Money, and now they're integrating Redfin and those Mr. Cooper servicing operations. They want to own every single step of the journey.
And the engine behind that whole system is data and AI. They're leveraging 30 petabytes of data from over 160 million client interactions a year. 30 petabytes. I mean, that's just an enormous amount of data. How does that translate into a real competitive advantage that smaller players just can't match?
Well, it's the difference between guessing and predicting. That huge data pool feeds their proprietary AI tools. And that does two things. First, it allows for incredibly precise lead targeting. They know which client is most likely to refi. And second, it drives automation. Their AI can process and approve loans way faster than competitors who rely on people. Speed and less friction, that becomes their moat.
And you can see that tech translating into results, right? I mean, customer loyalty. Rocket Mortgage has been ranked #1 in customer satisfaction by J.D. Power something like 23 times.
It certainly has. Plus, their client retention rate is at a remarkably high 98%. Once a homeowner is in their ecosystem, the switching costs are just demonstrably high. It's a huge defense mechanism.
So you have all this fundamental strength, volume recovery, high margins, a data moat, a huge MSR war chest, all just sitting there waiting for the macro catalyst. And we saw what happens when that catalyst is even just rumored. That 17% weekly surge when people got optimistic about a December Fed rate cut. This stock is basically a highly leveraged play on the housing and rate cycle.
Exactly. If you connect this to the bigger picture, the market is already pricing in a pretty significant upcycle, which, explains the aggressive run we've seen.
Okay, so that all sounds incredibly bullish,
Yeah.
but
Yeah,
there has to be a but, right? We need to flip the coin and look at the risk they're facing.
of course. The first major one is integration risk. We just talked about the acquisitions of Redfin's mortgage unit and Mr. Cooper's assets. They had huge scale. But merging tech stacks, aligning different corporate cultures, and making sure those projected $60 million in synergies actually show up, that's a huge operational challenge.
Right, and there's also a critical accounting issue you have to watch if you're trying to figure out their real earnings power. Their adjusted net income in Q3 was a positive $158 million, and it's growing. But the company still reported a GAAP net loss of $124 million. Why is there a $282 million swing between those two numbers?
That is probably the single most important distinction for anyone trying to understand this company. So GAAP generally accepted accounting principles. It requires them to count large non-cash expenses upfront. Think of it like a business owner who reports a paper loss this year because they bought a new expensive machine. It's a massive expense now, but it's going to generate revenue for years and years.
So the GAAP loss is mostly because of long-term strategic investments and those complex MSR fluctuations. It's not about them just burning cash on day-to-day operations.
Precisely. The fact that their adjusted operational income is positive and getting better suggests the underlying cash earnings power is solid. But it means investors have to look past the headline GAAP number to really get the full picture.
And of course, you've always got the legal and regulatory cloud hanging over the entire lending sector.
Yes, and this is an important point to consider. We have to mention the potential legal scrutiny. Specifically, a notice from Gerard Sharp about an investigation into the Mr. Cooper merger materials. There was also an earlier FTC lawsuit involving a subsidiary. Now, it is crucial to state that this investigation is at a very early stage. No adverse findings have been disclosed. We're just reporting the facts of the notice here.
And I guess the most obvious risk of all is just timing, macro timing. The entire bull case really hinges on the Fed lowering rates in a big way. If they slow down or if inflation comes back, that whole refi recovery gets delayed.
That's the main driver of near-term volatility, for sure. The market has priced in a lot of optimism. If the Fed disappoints, the stock will correct quickly. It's a timing risk.
And really quickly, we should probably touch on the insider optics. A director sold about 5,000 shares recently.
Right, and we should frame this as pretty standard procedure. That sale happened under what's called a Rule 10b5-1 plan, which is set up way in advance for routine diversification. It was a small sale relative to his total holdings. And the fact that it happened right after they reported strong earnings suggests the market correctly saw it as neutral.
Okay, so let's bring this all together. What's the core takeaway for someone listening?
I think Rocket Companies is fundamentally a story of extreme cyclical leverage, but it's combined with a clear structural advantage in AI and their platform. They have the financial strength, that $13.6 billion asset base, to weather this environment, and they are perfectly positioned for when the refi market reopens.
So the primary horizon for this investment is definitely a multi-year hold, probably 2 to 4 years to really capture the benefits of the cycle turning. It feels like they're really trying to shift the narrative away from being just a boom and bust mortgage originator.
I agree. Their emphasis on the platform, that 98% client retention, and the ability of their AI to synthesize those 30 petabytes of data, it shows they are moving into a much more sophisticated fintech category.
Absolutely. And I think the question you should be mulling over is this. Will this technology moat protect their market share enough to allow them to weather future cyclical downturns better than they did in the past? Because if their platform truly creates that resilience and those sticky customers, the long-term value proposition changes completely, regardless of what the Fed does next month. That's the lowdown on rocket companies for today. If you haven't already, subscribe so you don't miss our next breakdown. We'll catch you on the next one.